Assalamualaikum warahmatullahi wabarakatuh. Alhamdulillahilladzi hadana lihada wa ma kunna linahtadiya laula an hadanallah. Asyhadu an la ilaha illallah wa asyhadu anna Muhammadan abduhu wa rasuluh. Allahumma shalli ala Muhammad wa ala alihi wa ashabihi wa man tabi'ahu bi ihsan ila yaumiddin, amma ba'du. Hello everyone, meet me again in Industrial Management lecture. Today we want to discuss about the stock valuation. Stock valuation, the stock that is not the inventory, but that mean is in Bahasa we can say this, the stock is saham, not inventory. The stock term is here in investing, fundamental of investing is about the saham. Okay, we start here. To valuing a stock, we have to value a company. Value of stock depends the future return from dividend and capital gain or loss. Depend the future return, because this is the investment decision always talking about the return, how much the return. Because its future is mystery, we have to know how to predict the future return that come from dividend or come from capital gain. It can be dividend or capital gain. How we can predict the future result? How we can predict the future? How we can predict the future? We can use the historical data, the past result. The past result is historical data. We can use the historical data of the company and its profitability to predict the future result. But this is not a guarantee. This is not guarantee. So it's not exactly same. The successful of the company and its probability in the history will give us the success in the future. It's not guarantee. But we can use the historical data to evaluate the future return of the stock. The information that used for forecasting, we want to forecasting the future result. We can use the past price, the volume. The volume is the level of the trading or the transaction of this stock. And then we can evaluate the financial report of the company. It can the financial report is the final reports are income statement, balance sheet, and then cash flow statement. The statement and the balance sheet, and then the macroeconomic condition of the country or the global economic condition. Okay, there are three factors that we have to use to forecast the future return that we will get from the stock that we buy. Okay, we can valuing a company and its future, or we forecast normally involve an overview. We have to see the sales and the sales growth, and then the profit margin. The profit margin is the convert of the sales into the earning. The sales into the earning. That will show us how the best operation of the company. The profit margin will show us how the operation performance in the company, the operation efficiency, the efficient operation or not, we can see from the profit margin. And then the return on equity, ROE, that means the return on equity on the capital, return of the capital. The convert equity into the earning. How we can produce earning from the equity that we have. How we can produce the earning. How the level. We can measure this by the return or ROE. And then the payout ratio. Payout ratio convert the earning into dividend. Dividend is the income of the stakeholder. The dividend. ROE and payout ratio are also used to project future growth rates. Project future growth rate. High return, low payout, that means high growth in future. High return, low payout, that means high growth in future. Why? Because the return or the earning of the company used to reinvestment. So it will be higher the equity and higher growth, I think, in the future. And then the price to earning or price to book ratio. Price earning to book ratio. If this ratio are stable, one can use forecasted earning book to predict future price. When this is stable, this ratio is stable, we can predict the future price. So we can predict the future price of the stock by price to earning book ratio, time by time. Book value refer to accounting value and from record on the balance sheet. That record on balance sheet. So to know about the price book ratio, we can see the balance sheet of the company. Because the balance sheet of the company will inform us about the book value of the capital of equity of the company. Okay, that is the parameter to measure the value or performance. I think the value, that means the value is the performance of the company. See by the investor. The investor need performance company in this measure parameter: the sales growth, the profit margin, the return, the payout ratio, and then price to book ratio. That is information that interesting for investor to measure the performance of the company and its future. Okay, next. We have table 8.1, the comparative dollar-based and common size income statement universal office furnishing in 2010 income statement. This is the income statement. Income statement in bahasa, we know about the income statement is laba rugi. The income statement. In this report or in this statement, this report will inform us about the net sales, and then give information to us about the gross profit. So this talking about profit margin, net sales, gross profit, that means the profit profit margin. Profit margin 809.5 per 1,938 times 100%. That is the profit margin. And then we know about the earning before interest. Earning before interest, we can see this. The earning will inform us about the return, the equity and earning. Earning will inform us about the return, but we need the equity. How we can get the information about the equity of the company? It's come from the balance sheet. Because this is the income statement, we don't know about the equity. But it's okay. We mark this, the earning before interest and taxes. And then we know about the interest expenses. It can be interest expenses, the bond from the bank, and income taxes. And then the net profit after tax, the net profit. So from the income statement, we got the net profit, net sales, and then gross profit, and we can calculate the profit margin. The profit margin, this information is very interesting for inform us about the operation management. Operation manager. The performance of operation manager is the profit margin. Okay, we have 3 steps here to valuing a company. The 3 steps are the forecast, the future sales and profit, and then future EPS, earning per share, and dividend, and then the stock price, future stock price. We can forecast it. We can forecast them, all of it, in the future. How we can forecast it? How we can forecast them? Future sales, always we can use the continued historic trend, the trend. And then net profit margin upon the earning forecast. It can be from continued historical trend. So the past, the data in the past. We can predict the future by the data in the past, okay, that we have. Assume last year's sales were $100 million, and then $100 million, and then the revenue growth is estimated 8%, and then the net profit margin expected 6%. So what the future of future after tax earning in the next year? 108 million. Where does it come from? Because the revenue growth is 8%. So in the next year, the sales will be, in next year will be 100 plus 8% times 100. That's equal to 108 million. Okay, and then times to the expected margin, and we got the margin or the future earning is 6.5 million in the next year. And then we have to forecast the earning per share or EPS. EPS, we can calculate the EPS by the future earning. That means the $6.5 million and the number of stock. Or we can cut the number of stock. For example, here we assume profit estimate is 6.5 and then 2 million share. So the estimate EPS is 6.5 time divided by 2 million, and we got here the $3.25. That is the price earning per share. And how about the dividend? Dividend come from here. Dividend is earning per share times by earning payout ratio. Dividend come from earning per share times by estimated payout ratio. We estimate here the payout ratio is 40%. So the dividend is 3.25 times by 40%. So the dividend is 3 times 25 times by 40%. And we got the dividend $1.30. How about the 60% from earning? The 60% from earning shift to company. What does it mean? But shift to company. Reinvest. To upgrade the level, to upgrade the capital of the company. And this dividend is paid to investor. So this is the return on investment in the investor side. In company side, return of investment is come from here. Return on investment in company side. This is in investor side. Okay. And we have the 3 steps to forecast the PE ratio, price per equity, per earning, price per earning ratio. It can be, because this is very relative, this is relative to the multiple or to the, we have to compare the PE ratio of our stock to the another stock. All stock, it can be all stock or another stock in the one field. In agro business, all share in agro business, we can compare the PE ratio every company in agro business. We can PE ratio in company in infrastructure, and then in consumer good and everything in the field, in the same field. Just up or down based upon expectation of economic condition, expectation of economic condition, and then the general stock market outlook, and then the change in company operation. What is it? Company operation? Maybe the company merger, yeah, or acquisition by a company, acquisition or merger. We can estimate PE ratio in function of several variables, growth rate, and then general state, and amount of debt in company, and then the projected rate inflation, and then in the dividend. Can estimate PE ratio by the several factors like this. Okay, and then it's very complex to estimate the PE ratio. Example, here we have assumed estimated EPS of our share is $3.25, and then the estimate PE ratio is 70.5 times. So the share price, we can estimate fair price is the EPS times by PE ratio. So the price is 56.88. To estimate the stock price in 3 years, extend the EPS PQ to 2 more years and repeat the calculation. So we can estimate the future stock price by the PE ratio and the EPS. The information of EPS and PE ratio. Okay, summary forecast statistic, Universal Office Furnishing, that is the company. Universal Office Furnishing, Universal Office, that is the company. And from this company, we have information here. Annual rate of growth in sales is 9.7 and average 5 years is 80.1. So this is low grade, yeah. 18.1%, and in 2030 the annual rate of growth is 9.7, dramatically decrease. Okay, and then the net sales is 1,938, and we get the net profit margin is 7.2. But in the past 5 years, the net profit margin is 5.6%. So the growth is decreased, but the margin is increased. What does it mean about this? Growth is decreased. You can see here the growth is decreased for 18 to almost 10, from 18 to almost 10. But the margin is increased from 5.6 increased to 7.2. What does it mean about this? The operation management, the operation manager or the operation management is good. It's good enough. And then we have information here, share price here, the share price 41.58, and then the dividend per share $0.15. The payout ratio is 6.6, year is 6.2, is average. The general is average. And then earning per share we have 2.26, but the dividend is 0.15. The payout ratio 6.6%. And what about the 93.3% from here, the earning? The 6.6% give to investor, but the 93.9% reinvest to company. What does it mean? We hope the growth sales in future will be increased, okay? Because the growth is decreased, so the company need more capital. So the payout ratio is low, 6.6%. So we can predict in the 3 years, 2014, 2015, and 2016. We predict here the sales annual rate of growth in sales will be 22%, and 19, and 16, 15, and then the share price will be 93.20. The capital gain is higher. That's come from 40. The capital gain is 93.2 minus 41.58. So it is good enough for investment. And the dividend, we got the dividend here 0.18 and 0.24 and 0.28. Okay, you can read this information when I question to you about the performance of the company using this data. I assume you can predict, you can see this, you can understand about you understand about this information and how to answer the future forecast. Okay, forecast for the future performance of the company. Okay, what use of the stock valuation? Once we have an estimate future stock price, we can compare it to the current market price. Look at this. Compare it to the current market price. We can estimate future stock price, and compare it to the to the current market price. Future to the current price of stock. To get this decision. And we know the share is this current price, this estimate price. We can see this is the this is the under value or fair value or over value. In bahasa we can say this murah, under value, and the over value is mahal, harga terlalu mahal, and the fair value that's ini biasa, biasa. Okay, we can compare this, the current price to estimated price. Okay, so I can give you information that the trading in stock market is not gambling. That is the investment. That is the investment activity, not gambling activity. Okay, so we can use evaluation, you can use the stock valuation to invest in market. How about the process of the valuation of stock? Valuation is a process by which an investor uses risk and return. Why? The risk and return concept determine the worth of a security. Security, that means the stock. We can see the stock, saham. It can be stock, security, that means the stock. A security, that is not keamanan, but a security is saham or stock. Valuation model helps determine what a stock. So the stock, that means is the security. Stock enough to be worth, and then expected rate of return equal to exceed our target yield. About the return, that means target yield is return. And then stock could be worthwhile investment candidate. We can choose the stock to invest. And then intrinsic worth equal to exceed our current market value, and stock could be worthwhile investment candidate. So, and there is no assurance, mark this, there is no assurance that actual outcome will match expected outcome. There is no assurance, but this is the prediction. Okay, prediction. Require rate of return. Rate of return, we have the target here. Rate of return is the return necessary to compensate an investor for risk involved in investment. The return is necessary to compensate an investor for risk involved. The return, risk and return. That is the investment, risk and return. Use as a target return to compare forecasted return on potential investment candidate. Example, assume a company has beta of 1.30, the risk-free rate is 5.5, and then the expected market return is 15%. What is the required rate of return for this investment? Required rate of return of this investment, the risk plus the beta times the expected, and that mean is risk-free rate and this is the return required. So it's very statistic. The stocks beta, market return, risk-free rate. Risk-free rate. Information here, this information come from the statistic data. Okay. The stock valuation method, we have another method to valuation of the stock. That is the dividend valuation model, the zero growth, constant growth, variable growth, and then the dividend and earning plots, dividend and earning, the dividend and earning, and then price earning, PEF, and then price to cash flow ratio, price to sales ratio, price to book value ratio, price relative, price to cash flow ratio, price to sales ratio, price to book ratio. Dividend valuation model, zero growth, use present value to value stock, annual dividend and required rate of return. Yeah. Assume dividend will not grow over time. Not grow over time. Stagnant. Zero growth. Constant growth is steady dividend payment. Steady dividend payment. Next year dividend, required rate of return, constant rate growth. A simple formula for student of engineering, I think. Expected growth, ROE, and then 1 minus payout ratio. Return on equity. Return on equity, not ROI. ROI, return on investment. For company, this is different. Equity is the own capital. Own capital. Equity is own capital. Investment, that means is asset. Asset, it can come from the capital of the company plus debit or loan. Capital plus debit give us asset. So the ROE for investment, return on equity, net income per total equity. A variable growth is variable growth. Okay, I screen. We skip this. Growth rate, appropriate growth rate, and assume stock value is capitalized value of it is annual dividend and dividend. That means capitalized, that means the price and the dividend. You know about the dividend? Dividend, present value to value stock. Okay. And very similar to variable growth, dividend value model, use present value to value stock. Assume stock value is capitalized value. It is annual dividend and future stock price. Works well with companies who pay little or no dividend. Maybe pay little or no dividend. One for this company, the price will go down when the company pay little or no dividend. Future price is based on your appropriate PE ratio, price per earning ratio. simple to use, easy to understand. Why using in the stock valuation? Why do they use in stock valuation? That is the common, the favorite to evaluate. The stock price is EPS times by PE ratio, PER. EPS times by PER, price earning ratio, the stock price. Okay. Similar to PE approach, but substantial projected cash flow for earning. Use cash flow, market price, sales per share, and then book value per share, P per PV ratio. You can evaluate using another method, but that information come from the report like this. Yes, this report. You can get the report here, this report in idx.co.id, stock exchange, the official stock exchange market in Indonesia, IDX. Okay, you get this information and you can calculate the PER and then the payout ratio, and then the PER and the dividend and everything. You can evaluate, use this information. Okay, thank you very much for attention. We have discussed about the stock valuation. I hope you can use this information to start in investing in stock market exchange. I will introduce you about the stock market exchange. We have many information in YouTube about the stock exchange. Okay, thank you very much for attention. We discuss the next topic. See you next. Assalamualaikum warahmatullahi wabarakatuh.